Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, October 18th, 2023. It's 11:10 a.m. Eastern Time, so I'm starting the video. So just wanted to get a quick one out to you and trying to collect my thoughts here. I won't make it super long. Let's keep it focused on really the equity indexes, but I'll loop in the semis because that is a big part of it. Semis, of course, are a subsector of the technology sector. Technology is the stock market, make no mistake about it. It doesn't matter nowadays what the banks are doing unless they're, crashing and failing. It's going to cause a systemic problem. But the banking sector, even not just the banks, the entire financial sector, is represented in the S&P 500. I'll show you. I haven't updated it recently, but every now and then I go and do the updates. Holding it's only 11 point, less than a 12% weighting in the S&P 500. It's almost a 0% weighting in the Nasdaq 100, and that compares to technology, which is over 50% in the Nasdaq and over almost about 26% or double what the financials are. So again, that's it's not that these companies don't matter, but if you're trading the stock market or invested in your 401k and S&P 500 index funds and things like that, then really where the tech stocks go, because they're so big, mainly the big magnificent seven, every other the top seven holdings in the Nasdaq 100 make up the bulk of the returns. Everything else you can add up, all 93 companies below that, and they really don't even hardly move the needle. These are the cold hard facts. All right. Anyways, let's jump into the charts. I started out. Let me go back to where I was, so I don't digress too much. Just kind of a heads up: economic calendar, which you can access on right side of the chart. I'll show you where in a second. It's under resources. Keep an eye on that. That's where things move lately, and this is all going to segue into. I'm going to get into some of the comments that have been made and how I've responded to those. But tomorrow, jobless claims and the Philly Fed Manufacturing Index, and then you have existing home sales at 10 a.m. So those two, jobless claims and the Philly Fed, is at pre-market 8:30 a.m. Eastern, and then existing home sales at 10 o'clock. You can go in there and get what the consensus is, and eyeball it and see, and turn on CNBC or Bloomberg and see where they come in at, or just even it'll refresh here if you refresh the screen shortly after the numbers come out. Bottom line is you'll see the futures will move on those numbers up or down, and we say the initial reaction is not the one that lasts, or more accurately, the initial reaction isn't always the lasting reaction. So don't, a lot of times the market will do a knee-jerk rip or dip pre-market only to see it all faded and then some later on. Okay, let's do this. Let's loop over to the website. I'll go over the questions I've answered recently. Just to update you, if you want to check out the economic calendar, go up here to the top of the screen where it says resources on the main menu of the site. Click on that, and then that'll load the Sports Center Tools of the Trade. Right there is your economic calendar. So that brings you to that economic calendar I showed you before. All right, back to that. Let's go back to the home page, and I encourage you, if you're, depends on your level of engagement to the markets, but come on back in from time to time and check the comment section. I'll go over the most recent post from yesterday. You can see I've kind of cut back a little bit on the analysis. I'm trying to dumb it down. No offense there. I'm just saying to keep it more simple lately, because I am starting to morph a little more into swing trading mode from active trading mode, and I'll speak to that in 1 second. And so, to keep it simple is, and again, I'll get to these questions. The trend, at least off the July highs, is clearly bearish. The market's making lower lows and lower highs, and as such, recognize the trend. And so, the last couple days, fired off a couple I know they're timely posts, short the rips, sell the rips. So, you've had the levels we're at now. This was on a Monday. Boom, we had multiple shorting ops, limited, not including, but not limited to that perfect tag of the downtrend line there. Then this one the other day, and we did go down from there, and then that was Monday. And then you had again yesterday was same thing. Time to short the rip. That was the previous post from the other day. This was yesterday's post saying this kickback to the 15,248 resistance with a minor downtrend line just above provides an objective, the next objective short entry add-on. So this, it's not rocket science. You take these shots. I always say you miss 100% of the shots never taken. And so recognize if, again, if you're in the same mindset as me, and if you're not, then take the other side of the trade. If you're bullish, okay, Randy says, here's he recognized, I agree that that's a downtrend line, but I think we're going to new highs. I think we're going to break out. So as a bull, you wait for a breakout above the downtrend line. That gives you a buy signal. Then the break above the next resistance, 15,353. Then most importantly, that primary downtrend line off the highs. So the bull would wait, those bullish wait for breakouts above these resistance levels. Those bearish take the opposite side of the trade, and instead of waiting for a breakout and anticipating a breakout, what they do is they want to short rallies back into resistance. It's really that simple. This is what trading is all about. And you can also set a tight stop just above there. Give it a little room, sometimes a 60-minute solid close above to prevent the little whipsaws and stop raids. You can have a more liberal stop, which again, when we were over here and we shorted this, kick back to the line, I said, very, very objective. One of the best, most objective swing shorting ops I've seen in a while. Short the trend line, the rally back to the trend line with stops somewhat above. Okay, so that's it. Let's not read too much into it. Again, I hate to oversimplify these things, but I think sometimes we can make trading too complicated, using too many indicators, listening to too many talking heads. You got to ultimately, at the end of the day, you have to make your own trades and decide where you want to go. And if you don't know what to do, I always say step back. If you're new to this, you got to walk before you can run. And so don't try to dive in head first, especially in a volatile market. It'll chew you up and spit you out. So anyway, that was yesterday morning. So that's where we were. Head up to the downtrend line. Do a quick update. That was in. This is now. So there it is. So we keep getting rejected. Here's that same downtrend line. And we keep getting rejected. Obviously, if we break it, and then more so, you have about 15, we'll call it 15,250 is pretty good resistance. That would could be the catalyst for another run up to the trend line. I wouldn't be crazy about that because we just tested it and got rejected. And usually, you can have that was a near run, but my preference and what I'm leaning towards is this: that we're not going to make a run there. But again, if we do, I'm giving you near-term stuff. You want to be an active trader, run up there. If we get there again, I'll say the same thing. It'll be an objective short entry with a stop somewhat above, same thing. And if you're bullish, and you see a breakout, then yeah, that's going to increase the odds that we're going to see that marginal new high scenario that I still cannot and will not eliminate until the purple key support levels on the Mag 7 that I've covered are taken out. And I've covered those in recent videos. Maybe I'll get to them again here. All right. And then ultimately also, additionally, this has been and continues to be, in my opinion, a very significant it was a resistance zone here. It was capping this trading range. Then you had an impulsive breakout. Resistance once broken becomes support. In that zone, the bottom of that is about 15,039, and we've had multiple trades. That was one of them I just showed you a minute ago from what was it, Friday, pull back to here, from a short down here. Said we'd get a likely tradable bounce off that level. That's what we got. We've had 3 tags of that level now. So here's my thoughts. Yes, it is support, and as I always say, support is support until unless broken. However, I'm less inclined at this point in time to continue to buy that. I've had a couple trades, active trades off that level, longs, covering shorts. But what I'm seeing is tap, tap, tap. the more you tap on a support level, the more likely it is to ultimately break. Now, until it does, again, support is support. Until unless broken, maybe they'll rally it off here. But and I don't think this market's going to go too far until it sees the jobs numbers tomorrow and the Philly Fed, and all the numbers coming out tomorrow. So probably you probably don't want to hear it, but expect maybe a little more of the same chop and slop. But as I always say, be ready for anything. It's just like war. There's times where you think nothing's going to happen. Think back to the Tet Offensive in Vietnam. Tet's Chinese New Year. American troops figured, okay, they're not going to do anything. They're going to be out partying and having fun. And it was one of the most successful campaigns from the for the North Vietnamese throughout the whole war. So because it caught troops off guard. Same thing with trading. There's days I wake up or go to bed and volatility's low, the VIX is low, market's trending or range bound, and barring some crazy event, economic calendar's clear, earnings calendar's clear, you can almost be go to bed with a high degree of confidence there's not going to be a big move overnight. But again, be prepared for it, because every now and then those things come out of the blue. And where I'm going with that is if you're going to bed at night, especially, I like trading futures because that way your stops, you're not going to wake up to a massive gap against your position. Have your stops in place in case there is that big move overnight. And if you trade ETFs only, absolutely, you should still use stops. Just be aware that you're going to be more subject to big opening gaps that may go against your position. There's not much you can do about that. But all right, back to where we were going here. So this is it, big trading range here. We've been testing. We were rejected off this trend line, and nothing's changed on my intermediate to near-term outlook, but we just need to take these levels out. And once we take out the recent lows back here from late September, early October, it should be lights out for the market. And that's going to coincide with a break of the purple levels I've given you, the key support levels on the market leading thing. So let's do this. Let's just color this line up, because we'll keep everything color coded, right? I've got those purple lines on the daily charts of the big market leading thing. So, again, roughly 15,039, 15,039. It's not a hard number. It's more incremental because you can punch down through. There's a lot of volatility. You can dip down, do that. Once you start getting away from that level, again, this was a breakout right here. And ideally, and it's been back tested several times. And if it go down here, then that means this whole thing was a false breakout, aka bear trap, whipsaw, whatever you want to call it. And as I often do, I'll tell you which way I think it's going to go. And then again, looping back to what I was saying, sorry to get so wordy on this. I'm starting to, although I always will active trade. Anytime I see an opportunity, during the day, I'm an active trader. I'm sometimes in and out of just something, one single security like NQ. It's not uncommon for me to make a half dozen or more, sometimes even at times close to a dozen trades in a day, just bouncing off short-term levels. I'll get to that in a second. But all right, so that's where we're at, guys. These are the levels to watch as of today. Downtrend line 15,250. And I'm sorry I'm doing this on the futures. I know I get the thing, hey Randy, a lot of us don't trade futures. I'll get to QQQ in a second. There's just more to see here. It's like if I'm a boater and a fisherman, and if you are as well, there's one of the absolutely what's a necessity for a fisherman or a boater, especially that boats shallow water like me, keys, all that, are polarized glasses, because it cuts a glare. You can actually see, put on a pair of non-polarized and then polarized. It's amazing. You can see down in below the water, the rocks, the fish, and all that, things that you may hit or fish you want to catch with polarized glasses, cuts a glare. So where I'm going with that analogy is the futures trade around the clock. So all these candles you see here and all these trades, all these reaction points, that's what determines support, resistance. A lot of these do not exist on QQQ, because QQQ, you're looking at a chart with the same NASDAQ 100 index. It's only trading between 9:30 to 4 p.m. During the regular session. Okay, so that's one reason I like to use these, even if I were to be trading QQQ. Okay, so just to recap before moving on, right here, I'll zoom in. That's where we were yesterday when I got out that most recent time to sell the rip again. We were right there, coming up on that downtrend line. So we had another rejection. If you shorted the trend line or just below it, so far it's good for about a 1.3% pullback in NQs. Now where do we go from here? That's what it's all about. You go again. I've thrown out a couple objective short entries, and I'll continue to do that. And I'll also, if and when my views change, I'll let you know. But again, we've already tested this level a few times. I suspect it's ripe to break. I told you last week, I think on Friday, that I suspect this might be the week. We've only got a couple days. We'll see what happens tomorrow with the economic reports, but this might be the week to finally get things going to the downside. We've been in mostly a trading range, although I'll speak to that in a second as well. Okay, while I'm on the site here, let me make sure, go back to the most recent post. Got a lot of comments, a lot of questions I answered. The previous posts, these were just kind of random, not questions, just more observations on the market. But one of them kind of ties into one of these questions here. Quite the rip on NQ. This was from, I think, Monday. Quite the rip on NQ and the Qs, not far from the downtrend line. So there's some relevance to me highlighting that one. I'll get down here, go to the comments section. Hopefully this is nice and big. I'll scroll in a little tighter. UNG, there's somebody asked about UNG yesterday. I told him, look, I'm not crazy. It fell back in the into the trading range, this trading range here, but it's at the midpoint of the range, and the midpoint of trading ranges often acts as support, 715. So that's said, and you can see here we had yesterday the PPO was starting to curl up. That's the PPO right there. RSI was at oversold levels. That's this blue line here, the 30 level. The last couple times you were oversold on the RSI and you had a bullish PPO crossover, you got these. So, for an active trader, there's trades to be made. So that's why, again, go back in, check these comments from time to time. If you're following, you can even follow a certain post. Where is it? Somewhere in here. You can go here and follow any individual posts and get updates there. Let me kind of going off on a little bit of a tangent, but since I talked about UNG, that was yesterday, 60 minutes. So there it is. So there's the bullish BPO crossover. It has occurred now, and there has been a little lift. Nothing much, but off that 715 level, about 2.5%. All right, back to the site. Next question, UNG. All right, I just shared my thoughts, linked over to that previous reply, SSD, some comment. Do you have any? Okay, this is the one I wanted to get to here. Randy, do you have any insights on the current volatility and reasoning behind it? There seems to be quite a bit of bullishness mixed in with these rips. I'd actually kind of missed that second part of the question. I'll speak to that in a second. All right, my reply. I believe that the bullishness you refer to is simply perception. When the stock market goes up, that seems to be, and in that particular instance, is bullish. Okay, so let me sidebar. How could it not be bullish if the stock, but minute by minute, second by second? So it really doesn't mean too much. My point is, don't take too much. One day I always say, and again, I'm sidebarring right now. This is what I first read back. I make up a lot of terms and phrases in trading and investing. One of them I like to say is, one day does not make a trend. All right, so one big up day, one big down day, to me, has zero, and I mean zero technical significance unless it's a breakout above a key support or resistance level. Then it is technically significant. Otherwise, an up or down day is just noise in the bigger picture, guys. Okay, so I wanted to sidebar that. All right, so I went on to say, as volatility, and of course you can look at the VIX, it's a measure of volatility, is elevated or rising, then the rips, just like the dips, tend to be more impulsive, meaning larger in scope and more swift in duration. All right, so you get those 1, 2, even 3% intraday moves or swings in QQQ. You get them when volatility is high, not when volatility is very low. That's very unusual. Hence, it is only natural that those rips feel bullish, especially if one's positioned short. That is because if you're short, whatever your number is, say you got 100,000 in the Qs and there's a intraday reversal, it's down, the market's gap down go down and gap down 2%. So you made $2,000 at that point on your short trade. You're happy. All of a sudden it rips and reverses and goes up to close the day up 1%. Now you saw a $2,000 gain evaporate and turn into a $1,000 loss in the matter of hours. Okay, guys, that's trading. Again, I'm just picking a round number. Your number might be much smaller or larger. Anyways, so don't read too much into it. So here's what I went on to say. Bottom line, take a step back and move away from what's happening on the 1 minute charts, the short-term charts, intraday, while taking a look at the bigger picture, i.e. the 60-minute or daily charts. The stock market has clearly been in a downtrend, making lower lows and lower highs since July. So again, I'm going to sidebar now. So hence the reason at this point I'm just highlighting, hey, if my view changes, if the trend changes, if we break above that downtrend line, okay, I need to then kind of take a step back and, hey, are we going higher? Should I abandon this whole we're in a downtrend thing? Until then, let's keep it simple. We're in a downtrend, so the value I can give you is get posts out to, or more importantly, I do these videos and give you the levels in advance so you don't have to wait for that post. So you can see where the resistance levels are. And so instead of, oh man, this 2% rip, man, we just went up 2% in 30 minutes in QQQ. It feels so bullish. You got to get out of that mindset. If you're in a bearish trend, welcome that. And then use it to your advantage to either add back some shorts you might have covered before, or if you plan to add more shorts or some new short exposure, ideally those rallies into resistance levels. And there's other factors you can use in the short-term charts. I'll get to in a second to help increase the odds that you're going to get a reversal there. Anyways, so again, just recognize that. And then finally, I wanted to add this. Okay, to add to that, during big corrections and bear markets, volatility is almost always elevated, so that's just something that someone will have to get used to if planning to profit from short selling during those periods. Okay, again, when the market drops, as it has been, the market peaked so far in July, and again, by every metric I've showed you, it's in a clear downtrend. It's no mere coincidence the VIX has been moving up lately. And we have that as an active trade idea right now, VXX. And so if you're new to this, just know that if you plan to profit shorting the market, now you can get out. If you don't, you might agree with my analysis, but you don't like shorting, it's just not your cup of tea, you're not comfortable with the volatility. Just know that if you plan to short sell, especially a bear market, even big corrections, the counter trend rallies are going to be above average. The dips, the drops are also very large. Those 3% plus swings in a day are the norm. And so you either have to accept that, and if you have the skill sets, and I try to get those setups out to you once in a while, but I can't get them all, 5-minute charts, 1-minute charts, you can turn around and profit from those, and they're immensely profitable, those little counter trend, if you're actively trading the intraday charts. But if you're not, let's say you're not, I think I'm speaking to most people here, you're just a typical swing trader, you don't, again, you work a full-time job, part-time job, maybe you're retired, but you don't want to be in front of the computer all day. But you do want to swing that trend. You're keeping your eye on the prize. You think this market's going lower and you're positioned short. Then you just have to get used to the fact that if you're going to short a downtrend, you're going to have bigger kickback rallies, both faster in time and bigger in percentage terms normally than the dips you have when you're alongside bullish trader in a bull market, if that makes sense, okay? And so either accept it. One of the things you can do if you're not that comfortable with those kind of volatility is, keep your position size relatively small. You don't have to hit home run. Let's say during a bull trend, your number again, let's say is 100,000. You want to put in the QQQ and, and trade it up. Well, maybe if you short, think of doing 70,000 or 50,000, whatever your comfort level is. Therefore, you can profit. You're just, it's on those counter trend rallies. You don't feel like puking in your mouth, right? So that's, and you can sleep at night. Okay, so that's that. I wanted to get that out there because it's really an important aspect of trading that if you are going to, and I always have and I always will post short trade ideas as well as long trade ideas. So you just need to understand that, as I said, that the difference of short selling versus long side only trading is I like it because the markets and stocks tend to fall. You can go back at any point in time, look at all bear markets, big corrections. Stocks fall a lot faster than they rise. So you can make a lot more money in very short order, but you not only have to accept this volatility, you also have to your timing has to be much more precise because those corrections, stocks fall faster than they rise, but those downtrends and the bear markets are much shorter in duration than the previous bull markets and bull rallies leading up to those. So you can't stay too late to the party, or you might have profited on a 50% bear market by shorting the whole thing all the way down. But if you waited for clear confirmation the bear market was over, guess what? The first, the rally off the bottom of that bear market is usually explosive. And then you've probably given back half your gains before you realized it. So, all righty. A lot of kind of sidebarring stuff today, but I just want to go over that. Okay. Please provide your latest update in stocks. I haven't covered it very recently, but here we go. Glad to stocks, which is a semiconductor ETF, was recently rejected off the downtrend line with the next sell signal to come on a solid break below the minor uptrend line. And I think that the semis still offer one of the largest profit potential for a swing short trade in the coming months of any major sector. Here's the chart I posted. Again, you can just log into the site, go to the comment section below that post, and there's these are the lines to watch. You have the downtrend line off the highs. No mere coincidence. It's the same high that the stock market, especially the NASDAQ 100, peaked mid-July, and there it is. So just like the NASDAQ 100, we had another objective short entry there. Just like the NASDAQ 100, I posted also on stocks, covering and expecting a bounce and gaming that recently, and so that's over. So the other line here, let me pull up the most recent chart, is there's a little minor downtrend line off the lows. You can see it right here. It actually comes all the way off the low back here, the October lows. That's the downtrend line right here. I'm sorry, uptrend line. And that forms this triangle pattern. So whichever way this breaks, especially if you break above that 509.50, that's going to be bullish for the semis. Could give us that marginal new high scenario, be a big old wedge. I still don't favor that, but I will not and cannot eliminate that until those other things happen that I need to see on the big Mag 7 stocks. So we're right there. We're at support. And as I like to say, support is support until unless broken. So do you short the semis today? In my opinion, no. You should have shorted them here, here. We were short here. There were a lot of places there. This is what I talked about, being an active trader, gaming counter trend rallies. As I did, clearly, stocks, the semis hit the 200-day exponential moving average, 2 days. They hit that uptrend line off the lows, which I since added, but it wasn't there before, but there were other reasons on the 60-minute chart. And, so this is where a swing trader would have been able to sidestep a 8.5% counter trend rally and even turn around and profit on some or all of that going long. And so this is what it looked like here. You had a bullish falling wedge on the 60-minute chart. And this is what I'm going to do in this video, is go down, you drill down to these shorter term time frames. Here's the 60-minute. This is where it was time to get short the semis back here. You had a divergent high. The divergent high got bigger. You had the first move down, hit my first target there on the 60, had a counter trend bounce. And I think we'll go down, hit this next target there, T2. All right, speaking of the intraday chart. So we go back to QQQ. As I just mentioned, this is a daily. Last rejection off the trend line there. Here's that. Here's the trading range as it shows on QQQ. So although I showed it to you a little on the NASDAQ 100 futures I started with, it reads a little bit different. You can see I have support levels at 365, which I believe is a big one. There's a big old gap right there. So once that goes, we go on down. T1, remember, was all the way back here. It was already hit. No, I'm sorry. T1 was right here, the red line. When I zoom in, these things move around. There it is. T1 was hit back here. So as often is the case, the initial tag of my targets, you get a bounce, tradable bounce we had, took us back to the trend line, which was also the targets on that, on this board here. There, that was when the low, T1 was right here, the gap. We hit that, T2, T3, which was first at 372 or the downtrend line. That's the downtrend line off the highs, that was hit. That says if you rode it all the way up, congratulations, sell your long, turn around and get short. Now, here's what we're looking at. So just like the NASDAQ futures I started with, this is that level we keep tapping on. QQQ, it's the top of the gap. Remember on the NASDAQ futures, you don't see these gaps because this is where I was talking about using the whole polarized sunglass analogy. You don't see, it's invisible here because, overnight the futures were trading in here and had reactions up on the top of that level. So that's why they've been buying it here. It's also the top of the gap there on the NASDAQ. So we take that out, we go back down, and then really get the party started if we enter down below that 361.61, because what usually happens when you re-enter a trading range after breaking out, the next stop is usually back down to the bottom of the range. All right, so there's QQQ, there's your downtrend line right now, near-term downtrend line off the highs. And again, I do think this level will ultimately go, but if you want to actively trade, I've shared this 100 times in the past, thousands. This is one of my go-to, for active trading time frame. This is a 5-minute chart. Now, the whole premise and the tools I use for technical analysis, I'm a big believer of the KISS rule. Typically, when you see my charts, you're going to see 2 indicators on the bottom, the PPO and the RSI. There are others I use. I have a lot, on different time frames parked. But these are the simple ones. And I always say, if you're starting out, experiment, try them all, but just learn, settle with just a few indicators and learn them like the back of your hand. When I first started trading and using technical analysis, they all sound so good, and each indicator has its own pros and cons. Some work better in other market conditions, but these are the ones that I've settled on, and they're highly effective. And I sniff out the divergences, and you can see that's all these lines are positive or negative divergence. Divergent low is positive divergence, that's bullish. Divergent high is negative, and you can see all the highs and lows. And this is the swing trading time frame. There was a divergent low, it's not marked there. Sometimes these lines just kind of go their own way, or I just see them and I don't even add them all. I can just see the divergences. Divergent high correction, so divergent low rally, divergent high correction, divergent high correction, divergent high correction, divergent low rally, divergent high correction, divergent low rally, divergent high correction. All right, so that's a 5-minute chart, and that's a good one for swing trading. You can see here, this is that same support level we've been tapping for a while. So if it goes, there's a trend line here on the 5-minute chart that'll probably come into play down here. And so if and when we break this, that'll probably take us down there. It's also going to take us in that range. And remember, it's going to have implications on that longer term 60-minute chart. You want to get really granular, go down to a 1-minute chart. Here's a 1-minute chart of QQQ, just showing you the same thing, the divergent lows. So again, this is a world of an active trader, and if you're a typical swing trader, don't mess with this. But 1%, you're like, is it worth it, Randy? It's a daily chart. If you can get 1% on, let's just say hypothetically, 3 out of 5 days in a calendar week, you can get a 1% gain. So you're making 3% a week, 12% a month. Do the math on it. And of course, nobody bats 1,000. But again, that says, let's say you take a shot every day, and you're 3 for 5 or 4 for 5, whatever. Anywho, so you can see that it works. These same divergences that work here on this out on the 60-minute and daily charts and weekly charts, they work just as well here on the short-term charts. All the better when you can align these trades with breakouts above resistance or breakdowns below support. But there it is, divergent low, rally up to that divergent high, divergent low, divergent high, and even the small divergent low, small rally. Again, these rallies range from 1% to 3%, sometimes even 0.5%. This is our most recent one today. You zoom into the charts today. little divergent low right there, you know, and that was so far so good for intraday bounce of roughly 0.5%. But as I said earlier in the video, I'm getting to the point where I'm a little less eager to trade these, because this is an important point I want to share. That I think, and I said it on Friday, and I've said it again in this video, I think we're getting, it feels to me we're getting to the point where the hammer's ready to come down, because I'm not doing it in this video, but I have been going over the things to watch, my things to watch list lately, where I have a combination of all different things, a lot of them completely unrelated. I'm watching, you know, for example, obviously first and foremost, Treasury bond yields, which just made new 52-week or multi-year highs yesterday. I'm watching municipal bonds. I'm watching the California muni bonds, which are falling a lot more than other states, telling me there's probably a problem in California, something I've been predicting for a long time. What else am I watching on that watch list? I'm watching the banks. I'm watching the regionals. I'm watching the big banks. I'm watching big market-leading stocks, industrials, FedEx, UPS, retail. I'm just looking at that list, Visa, MasterCard. So where I'm going with that, guys, is I'm seeing just mounting evidence one after another. The stocks that I've been talking on and highlighting in that watch list for months now, one after another, have broken down or reaffirmed the yellow flags, or even turned from a yellow to a red flag, you know, a caution to a warning. And so, like I said, that's enough. And so I think the big drop is inevitable now. You know, most likely. I think the probability is very high. And so where I'm going with is sooner or later, and I'm starting to walk away from it this week, get out of this active trading mode, because after a while, when the shoe drops, when we break down, when the here, I'll get to it in a second here. When we start to get those more powerful sell signals on the big Magnificent 7 and QQQ falls down in that trading range, we break these supports, then those 5-minute divergences tend to not work. They work great. You can swing trade the heck out of the market in a choppy sideways market using just 5-minute charts, even 1-minute charts, 15-minute charts. But when the market finally breaks and it's clear to all that this isn't just a correction or some high-level consolidation before the market breaks to new highs, as the bulls are calling for. But once we break down here, this is my POR, point of recognition, I call it, another term I made up, where I think when we take out those lows, and I've been saying it for months now, and that was why that was T1, 354.70, give or take, in addition to the purple lines on these Apple and all the other Mag 7, 170 and then 166-ish right there on Apple. Microsoft need to take out 311.56, give or take. Alphabet 127.15. Amazon 123, and then that primary uptrend line right there in purple. So once those go, then I'm not really concerned much on the 5-minute chart, because I'm going to get divergent lows after divergent lows. They're just going to get burned through. They'll get sold into. At that point, I morph back into the longer term charts. I want to see most of the key stocks and the indexes falling to key support levels with bullish divergences out on the 60-minute chart is what I really like to see before I start covering short trades on a swing, you know, trend position, and then reversing long. So that is it, guys. That's my trading plan, kind of long-term, short-term, what I'm doing day to day, levels I'm watching. Remember, we've had multiple check marks recently. The last video I did, I think was it last week, that I covered all these uptrend lines. I said I went through here as I was doing the video and noted, some of them just seemed to go away, but maybe I drew it on a different board, that Apple and all these Mag 7 stocks had these little near-term uptrend lines. And I said that would be your next sell signal when they break and help check mark for the bearish case. And they did. Apple broke down. There it is. Microsoft holding the line right now, but right on it. Alphabet broke down. There's your breakdown candle. It's been back testing since. I'm talking again, these minor uptrend lines. Amazon broke down, big red impulsive candle, still well below the uptrend line. And Nvidia broke down right there, closed slightly below, back tested the next day, but failed to recover, and then boom. So that's it, guys. These are the check marks I'm seeing. Microsoft, sorry, Meta, I didn't really have a clean up trend line. Tesla, when do they? I think they report tomorrow. So yeah, this market, it's going to hang in there another day or two with the economic things. Oh, and of course, we're heading into earnings season. The banks have already mostly reported, the big banks at least. But again, they don't. They do matter to the economy, but they don't matter as much to the indexes. The big tech, that's what we need to see, and big tech will be coming up. And but to me, the charts already indicate where they're most likely going, and it may be a little more of a grind fest until they report. I don't know. Sometimes that's usually the case. Usually, you don't see them make a big move before they report. But there are times I've seen where you start to see profit taken in anticipation in advance of earnings. So the clearest message I can give you is just let the charts be your guide. Sometimes you have to take pre-earnings breakdowns or breakouts with a grain of salt. That's unfortunate. There's just there's no way around that sometimes earnings will change the trajectory of a stock. But I've said this often in the past, many times over and over, that more often than not, and much more often than not, if a stock has a clearly bearish or a clearly bullish technical posture leading into earnings, that's the direction it's going to go. Otherwise, it's a crapshoot. When I look at a chart, if I can't make a strong bullish case, and to me, and I'm different from most people, 99 out of 100 traders are going to tell you this is a bullish chart. Broadcom is up there, it's pushing on, about to break out, or just made a new marginal multi-year high. The trend is, a blind man can see that that's, the stock isn't an uptrend. But to me, this is a bearish chart. I see big negative divergences forming. I see a stock that just keeps breaking out the new highs, but there's no follow through buyers. And then I see a beautiful uptrend line in which to trigger a sell signal, and then my purple lines, which are just lights out for that stock. So I see, with a high degree of confidence, I can say that this stock will ultimately go on to hit my target, my downside target here, about a 27% drop, whether or not it has a post earnings pop or not. If it has a post earnings pop, actually, they reported back on September 7th, so they're not going to report for a while. But even if it went in sympathy with any of the other semis, at most it would be just a new marginal new high before this one reverses. All right, long video. I threw a lot out at you, but you know my thoughts, and more importantly, you know the levels to watch. Like I said, you may differ from me where you think the market's going. Hopefully you find some value in these levels. So if you're a bull, instead of waiting for a break of this trend line to short Broadcom or add to a short, you want to buy a pullback to the uptrend line. So likewise, bears want to short the breakdowns of these support levels, and then maybe look to cover that short and go long when we get down here, or game the counter trend rallies along the way. All right. I'll stop it here. This has been Randy Finney with Right Side of the Chart. Have a great day.